Hey, what's up, guys? Welcome back. My name is Darius Watson. If you do not already know me, now in the last video, I said I was going to address the policy fees. So my 6 p.m. canceled, so I'm able to go over these fees right now. All right. So one thing that a lot of people don't know is that it's still an insurance product. And just like any other life insurance product, you have fees. All right. So the main thing that people already know is things like your age, your death benefit, your gender, and then the sex, meaning male or female. These are some of the things that they charge you for, along with the cost of insurance. But you have additional fees as well that play inside of insurance products. So today I'm going to go over not only the policy fees, but I'm going to show you inside of the actual illustration on an example on the expense report so you can see exactly what you're paying for year by year and how the policy fees either drop off or add on depending on the age, or if you have things like riders and things like that. And I'm going to explain that as well. So if it's someone that wanted to know exactly what it is you're being charged for inside this policy, this is the video for you to watch and you're in the right place. All right. So without further ado, let's go ahead and get into it. All right. So here we have the Index Universal Life, or what you may know as the IUL. All right. So inside these IUL policies, you have premium charges, which are also known as fees. All right. So the premium charge is a percentage deducted from each premium payment to cover initial policy costs and expense, usually somewhere between 5 to 30% of the total premium. Now, the reason for the gap is because if you're someone like me, let's say a disabled veteran, you are charged more because we have a lengthier health record or whatever you may say. So if you have more things on your health record, you're going to be charged more. Now, I'm grateful to not have diabetes and anything significant like that, that is going to cost me too much in fees. So my expenses is not as high as you may think. But if you have like diabetes and things like that, I know most people feel like they cannot get the policy, but with additional underwriting and extra risk assessment, you are still able to get policy. And I'm going to go over how that works. All right. So the first thing you have is the cost of insurance. All right. And these are just the fees deducted from the policyholder account. And these are the things that most people already know: the age, the gender, the health, and the death benefit. These are the fees that are charged off the bat inside the policy, right? So no matter what the policy is, you're going to be charged the cost of insurance, all right? And then you have the fees that you don't know about that you're charged. And that's going to cover these last remaining fees here. All right. So you have what's called a policy issue charge. Now, believe it or not, you are charged to get the policy, meaning that when you have underwriting, which everybody gets underwriting for any policy, distribution and risk assessment, you are charged a fee for that. It's a one-time fee, but you are charged. So that's why a lot of people don't know that, because it's not a recurring fee, but it is a one-time fee that the insurance carrier charges you. And that's how they are able to get the underwriting, the risk assessment, the setting the policy up, and things like that. All right. And then you have what's called additional charges, right? So let's say if you want to add a rider, let's say you have a child, which by the way, I wouldn't recommend. I would actually recommend getting your child a child IUL policy. I'll cover that on a different video. But for this example, let's say you add a child rider on there, or you add what's called a any kind of rider, like a accidental rider, meaning that you're covered for accidents as well. You would then be charged an extra fee. All right. And that extra fee is just for extra riders and things like that, that is not usually associated with the policy, but they give you the option to add those things on there at a lower cost than just getting, if you were to get an accidental policy by itself, they'll charge you a lower cost just to add it onto the policy. All right. Now, you also have things called bonus interest crediting charges. All right. And these fees now, it's kind of a double-edged, not really a double-edged sword, because you usually get these credited back after 10 to 11 years. And you will see that reflect on the expense report inside of your policy. So this is basically the insurance carrier saying, we charge you a lot up front because we want to make sure that these policies are being utilized for what they're supposed to be utilized as, being a long-term policy. So we're gonna compensate you for that by giving you that money back after you meet the recommended minimum 10-year time span that we, want you to have policy for. All right. So they usually credit these fees back, not always, but the good insurance carriers definitely credit these back to you. All right. And then you have things like additional policy credit charges and things like that. Now, this is not going to apply to everybody. All right. And these are just fees associated with granting additional credits or benefits to a policy account value beyond the standard allocations. Now, I doubt you won't even have to worry about this, because 9 times out of 10, you're not going to have this. All right. So I know you're probably looking at this and it's like, okay, it looks good, but you want to see exactly what it looks like in correlation to an actual policy. So what I'm going to do is I'm going to show you a policy that we went over in another video, but I'm going to show you the expense report on that policy. All right. All right. So as you can see, this is one of the policies that we went over on another video, and this is the option B increase in policy. So the charge is not really as high as if it would have been an option A, because the death benefit is lower. In this example, it's $350,000, where usually $12,000 of annual premium payments inside a policy for a 35-year-old would be much higher. So on this example, the fee is actually a little bit less because of the type of death benefit that we have. And we have the riders that already come with the policy attached to the policy. So there's no additional riders on this policy to have additional charges. So we're going to break down piece by piece every column that we just went over. All right. And this is this is in every illustration, by the way. So if you have an IUL policy already and you didn't know this, somewhere in that IUL policy, you have a expense charge report. All right. And this is what it looks like. And it shows you your premium payments for the year. And they show you the charges. Each charge that we just went over is in this policy and it's shown throughout the year. These are annual numbers. So these are the premium expense charges. They're charging this client, 35 years old, year one, $12,000 of payment, of premium payments. He have a $900 expense charge. He has a cost of insurance. This guy in particular, in this case study, does not have a lengthy health record. So his charges are not really that high. This is a pretty standard person who, somewhat healthy for American standards, I guess. And then you have the expense charge report, $825, and you don't have any additional riders like child riders, accidental riders, spouse riders, things like that. So all of these 992 and 825 equal up to a total expense charge of $1,817. All right. And you're going to see this reflect, so you put in $12,000 of annualized payments. You have an expense of $1,817, and you earned $45 for that first year. All right. And that's going to bring your account value to here. And that's where you see all of this reflect. So if you do the math of this 1,200 minus all of these charges here, and then you add the interest earned, you should come up with $10,228 of account value. Now, because they want to make sure that you're not just trying to grab this policy and cash it out soon, like I told you, they want this to be a long-term policy. This is not structured to be a get in, get out. It's not a get rich quick. I had a couple clients that, was under the wrong impression that they can just throw money in here real quick and then take a bunch of money out by year 2 or something like that, year 3. Yeah, so it's not going to work. So if you're someone that is looking to utilize this policy, off topic from the actual video, but this is not a short-term play, I guess you can say, or a quick flip scheme. You know, this is a long-term compounding interest, safe, protected vehicle asset that you can use, and your cash value is going to show and reflect that. You know, you're going to start seeing the expense charges drop off after year 10, like I told you. Now, in an example, when I know you remember when I told you you have those bonus interest charges, they don't show that here because in this example, they're not charging this particular person anything more. This is pretty standard, so they're not going to charge them anything extra. So if it was a case where it was some bonus interest credited back to you after year 10, it would show somewhere they would have an additional column here, and it would show it start reflecting back inside of the policy on the interest earned. All right. Well, in this example, you don't have that. But what you do see is as you get older, that cost of insurance goes up, just like anything else. The older you are, the more you are charged for insurance, right? So your first year at age 36, you was only charged $92 cost of insurance. And this is in every life insurance product, right? That's why you want to get life insurance as early as possible to make sure you can lock in the lower rate, and that way more money actually hits your cash value and your account value, right? So even though you can see the cost of insurance going up, you do see inside the IUL, they charge you less after you hit your 10-year mark, all right? After 10 years, that $825 drop all the way down to $60 a year annually, right? And then so on and so on. And you'll just see that reflect throughout the entire expense report. And the reason I wanted to show this is because a lot of people are not familiar with how it works. And this is what people don't understand when they say IUL has fees, but every life insurance is going to have fees. You're never going to have a life insurance product that's not going to charge you for insurance. And the reason why this policy is cost of insurance is going up so high, remember, like I said, it's because the death benefit is increasing every single year. So you're getting charged more for the policy fees. That's why in some of the other illustrations, you would see me pick the option of an option B that converts over to more of a level option A death benefit. That way the death benefit can stay as low as possible. If it stays option B, it's going to increase still because that's just how it's structured. You have to make sure it's structured properly to try to save as much on these fees in these later years, all right? So this is just an example, and I just wanted you to be able to see this so you can see where exactly the money is going inside of the policy, what it is you're being charged for, and that you are being charged for this policy, okay? Just like any other life insurance product. All right, so that's all I have for you today. Hopefully I answered the question of policy fees and how much you're being charged for a natural IUL policy. So I just want to leave you with this little bit of information, and just for people to know, you're going to be charged fees regardless. I don't care if it's an IUL, I don't care if it's term, I don't care if it's a 401k, you're going to be charged fees, whether it's government fees and taxes, like fees for death benefit or whatever. Now, the good thing about the IUL is you can beat those taxes because, as you all know, inside of a 401k, the way it's structured, you're going to be taxed on the tax bracket that you're in when you're older. And 9 times out of 10, you're going to be making more money when you're older, when you're ready to retire, than what you were making in your earlier years. So it's really not set up for you to be able to pull that money out without getting hit with those government fees. So you do pay fees inside of the IUL policy, but the difference is it more than makes up for it when you start looking at the tax-free income aspect of it. Because the thing is, you want to get your income, but you want to make sure you can get rid of as many fees as possible. So the IUL is structured to where it's going to charge you the regular life insurance fees as a life insurance product, but it's not going to charge you the government fees being taxes, okay? So that's all I have for you. Again, not going to take up too much of your time. Hopefully you learned a little bit. Hopefully you have a better understanding about the fees. If you guys want me to address anything, or if you didn't understand anything about the fees in the policy that I just went over, get in the comments, let me know, tell me what it is you want me to cover, and then I'll do my best to throw it in a video and address that for you. Until next time, you guys take care and hit that like and subscribe button before I get up out of here. I almost forgot, man. Y'all make sure you hit that like and subscribe button and tell your people about me, because I'm just here to give you that information. You know, we're not going to hold nothing back. We're going to uncover everything about the policy. You know, get in the comments and let me know what it is you want to know. All right. Until next time, you guys be safe. Take care. See you later.